Hello. So today I'm gonna be doing the session three assignment. I'll show you guys my process. So first, let's look at the assignment. What it's asking. So my mission is I'm in an imaginary scenario and I've just inherited 75,000 from my great aunt who always said invest in quality companies. And then I'm considering Microsoft stock, which is currently trading at $380 per share. So here's some key information in this world. Microsoft pays an annual dividend of $3 per share. Dividends have grown at 10% annually for the past 5 years. Analysts expect 4% growth going forward. The S&P 500 has returned 10% annually on average. Treasury bonds currently yield 4.5%, and I could alternatively put the money in a savings account, and that would be at 4% annual interest. So the first question to explore is what is Microsoft worth using the dividend discount model? How sensitive is this valuation to growth assumptions? And if I buy at $380, what return can I expect? And then is the 380 a good buying price? And if I should invest 75,000? So so that question this is the answer I got with the help of Gemini. So So it's saying the DDM is extremely sensitive to changes in the assumed dividend growth rate, and a small increase in this rate can drastically change the intrinsic value. So this model assumes that constant growth rate forever, which is a major simplification. And Microsoft's actual dividend growth rate has been around 10% over the past decade, which is much higher than the 4% which is used in the model. And then to do this with this formula, as the rate would be about 7.2%. And so here's the calculation right here. And that's a high bar for a company of Microsoft size to maintain indefinitely. And so if we keep going down, what we're expected in return, if we were to buy Microsoft at the market price of 380, which let's go back to this is what it's asking. So if we were to buy at that, the return that we would be expecting is approximately 4.82. The way this is calculated is by adding a dividend yield. So right here to the expected growth rate, which is 4%. And this is much less than the required return of 4%, 8%, which indicates that the investment may not meet my performance expectations. So in deciding this, whether I should invest 75,000 or not, or to invest somewhere else, it says that the DDM is a poor fit for Microsoft. Um, because this company is a growth stock that reinvests a large portion of its earning back into the business, and so it's not really worth it. And the other valuation metrics are more relevant. Um, and a better approach that for this scenario would be the price to earnings ratio and discounted cash flow analysis, because Microsoft's PGE price to earning ratio is around 38, which is higher than the S&P 500 average. So it's a good buying price and it depends on my investment strategy. If I'm a value investor, which in this scenario I wouldn't be a value investor, I would focus on stable dividend paying companies and believe the stock should be valued by DDM. Then if I was the value investor, then 380 will not be a good buying price, and I should just look into something else. But in this case, if I said I was to be a growth investor, then I can consider the price a fair entry point. It's a good starting point. And so some recommendation that it gave me was to not invest the full 75,000 Microsoft stock based on this analysis, because the stock is overvalued and mod the model is not really best fit for the Microsoft. And the expected return of 4.82 is too low, and so that's already a red flag. And why I should invest in this. And so, and if you go here, here's the code. So right here is the current dividend, which is 3, expected growth rate 0.04, 0.08 for the required return. That's the next year's dividend, the growth model, the expected return. Yeah, it's all that good stuff. And on the bottom, this shows the Microsoft, the dividend growth or the intrinsic value by the dividend growth when the market price is set at 380. This is the discount rate. Yeah. And then if we scroll up here, so I searched up Microsoft stock just because it relates to it, and then you can see that's at 519.71, 0.34%. And then the after hours is all that good stuff. Mm, mm, mm. Okay, and then here's some information that I typed up or asked the Gemini to type up for me that I could translate into Collab. It says the interest rate derived from the DDM, which is $78, which is lower. It's below the market price of 380. Yeah, the stock is overvalued, like we just talked about. Sensitive analysis pause demonstrate how the intrinsic value of Microsoft's stock changes in response to variations in the key inputs, the dividend growth rate and the required return. And then so the growth rate for this. And it illustrates that the value of Microsoft stock is highly sensitive to changes in the dividend growth rate, the red dashed line, 380. Okay, let's see. Red dashed line at 380. So it's talking about this right here. It represents the current market price. So this red line right here. Um, and it's to justify the market price with the DDM. And the dividend growth rate would need to be much higher than this, so 4%. The graph shows that even with the high growth rate of 7%, the interest value is only around 300, which is still below the current market price. And you can see that you can see those informations right here. And the second plot, so it's talking about this plot right here. All right, okay, wait. Let me go back real quick. So this the growth rate sensitivity is referring to this graph right here. See the 380, the red line, and then the growth rate, which reaches up to 300, 300 like 20, I would say. And then the discount rate sensitivity, which is this right here. There's the 380 red line like up here. And then here's the discount rate that went up or the interest rate value that went down as the discount rates went up. So yeah.